You didn't lose money today, nothing was stolen, no fraud alerts, no red numbers flashing on your screen, and yet you're poorer than you were yesterday. Not by a lot, not enough to notice, but enough that, over time, it changes everything. That's the unsettling part. Money doesn't usually disappear in dramatic crashes or sudden losses. It fades, quietly, predictably, systematically, and most people never even realize it's happening. Imagine you wake up one morning and your bank balance is exactly the same as yesterday. Same number, same digits. Nothing changed. Feels safe, right? But then you go outside, coffee costs a little more, rent ticks up, groceries feel slightly heavier on your wallet, nothing outrageous, just off. You shrug it off. Prices go up, that's normal. Except here's the part no one really explains clearly. If your money stays the same, but everything else gets more expensive, your money didn't stay the same, it shrank. We call this inflation, but that word is almost too clean, too technical. It sounds like a natural process, like air filling a balloon. In reality, it's closer to something else. Dilution. Think about ownership. If you own 1 out of 10 shares in a company, you own 10%. But if the company suddenly creates 10 more shares and gives them to someone else, your 1 share still exists, but now you only own 5%. Nothing was taken from you directly, but your slice got smaller. Money works in a strangely similar way. When more money is created in the system, each unit of money represents a slightly smaller claim on real things: houses, food, energy, time. And this is where things get interesting. Because new money doesn't just appear everywhere at once, it enters the system in very specific places. Let's follow it. New money is usually created through banks and central institutions. It shows up first in financial systems, loans, asset markets, government spending. That means the first people to touch that new money aren't you buying groceries. It's large borrowers, corporations, financial institutions, governments. They spend it before prices fully adjust. They buy assets, real estate, stocks, infrastructure at yesterday's prices. Then the money spreads, it moves outward through salaries, contracts, services, and by the time it reaches you, prices have already moved. You're now paying more for the same things, but your income hasn't caught up yet. So even though the system looks stable, there's been a silent transfer of purchasing power from later users of money to earlier ones. This is why inflation doesn't feel like a single event. It feels like pressure, slow, constant, hard to measure day to day, but devastating over time. Let's make it real. If inflation averages 3% per year, that sounds manageable, almost harmless. But over 10 years, your money loses about a quarter of its purchasing power. Over 20 years, it loses nearly half. That means something that cost $100 today could cost $180 in a couple decades. Same item, same value, different price. And unless your income rises at the same pace, and it often doesn't, you're effectively moving backwards, not dramatically, just enough that life feels tighter. Here's where the story gets more uncomfortable, because inflation isn't just an accident, it's often a feature. Modern economies are built on debt. Governments borrow, companies borrow, households borrow, and debt becomes easier to manage when money is worth less over time. If you owe $100,000 today and inflation quietly reduces the value of money, that debt becomes easier to repay in real terms. You're paying it back with cheaper dollars. So from a system-wide perspective, a little inflation greases the wheels, it keeps spending going, it reduces the real burden of debt, it encourages people to invest instead of hoard cash. But there's a trade-off, because while inflation helps borrowers, it quietly punishes savers. If your money is sitting still, cash in a bank account, it's slowly losing value every year. Even if the number goes up slightly with interest, it often doesn't keep up with inflation. So you're earning, but still falling behind. It's like trying to walk up a down escalator. You're moving, but not fast enough. Now layer in something else. Asset prices. When new money enters the system, it doesn't spread evenly. A large portion flows into assets, stocks, real estate, financial markets. This pushes asset prices up faster than everyday goods, so while inflation might officially be 3%, housing might rise 8%. Stocks might surge 10%, which creates a strange split reality. If you already own assets, your wealth grows. If you don't, everything you want to own gets further out of reach. Same economy, same inflation, completely different outcomes. This is why people often feel like the system isn't working, even when the numbers say it is. GDP grows, markets rise, inflation looks under control, but daily life feels more expensive, saving feels harder, and long-term stability feels fragile. There's also a psychological trick happening. Because inflation rarely shows up as a direct loss, it shows up as higher prices. And humans are surprisingly good at adapting to higher prices. We normalize them. We forget what things used to cost. We adjust our expectations. So instead of feeling like we're losing money, we feel like things are just getting more expensive. It's subtle, but it changes how we react. We complain, but we don't panic, and the system continues. Now zoom out. This isn't just about prices going up, it's about how value moves through an economy. Who gets access to money first? Who benefits from rising asset prices? Who bears the cost of gradual dilution? And who doesn't even realize it's happening? Because the most powerful systems aren't the ones that shock you. They're the ones you adapt to. So the next time you look at your bank balance and think, nothing's changed, ask a different question. Not how much money you have, but what that money can actually do. Because in a system where money is constantly being created, standing still isn't neutral. It's losing ground. And that leaves a question most people never ask out loud. If money is designed to lose value over time, what's it really supposed to be used for?